Metal markets are moving fast, but is it a breakout or a bluff? This is Sectors Up Close, and we're talking about metals. For decades, metal prices moved with fundamentals, supply, demand and inventories. But the game has changed. The AI and EV boom, as well as rising geopolitical risks, are all redrawing the map. Meanwhile, mining is getting riskier and more expensive. Yet traders are cashing in. Copper premiums are soaring, precious metals are ripping, and momentum is building. But with fear driving the rally more than the fundamentals, what happens when sentiment shifts? Let's ask Joy Yang, Head of Product Management and Marketing at MarketVector Indexes. So Joy, let's start with gold. It's been a 25-year bull run, slow at first but now supercharged. Can this fear-fueled rally last?
Equities have been focused on this AI story, which, it loves pricing in innovation, but equity markets have a difficult time pricing in some of these macro risk. And we saw on Friday, there is still a lot of macro risk, and we're seeing now there's still a lot of global tensions. And, even if we do reach settlements around some of these peace negotiation or tariff negotiations, there's still a lot of uncertainty out there. And that's why gold has been this steady, progress, relentless uptime, all-time high.
But with gold breaking above $4,000 an ounce, is it now too pricey to enter? Have investors missed the boat?
There's a lot of lack of trust across the world, not just in the US, but if you look at France, Japan, Argentina. So when you talk about this lack of trust, what's the alternative, right? There isn't a lot. And that's why we continue to see central bank buying into gold. And now we're seeing retail come back into gold. So September was one of the largest flows into gold ETF markets. And more importantly, we're seeing this institutional wake up to gold with Goldman pricing gold at 5,000, with Ray Dalio calling for a 15% allocation to gold, and even Morgan Stanley talking about the new 60-20-20 allocation to gold.
Other precious metals, including silver, are spiking too, though. They're hitting multi-decade highs, but without central bank support, is this rally built on shaky ground?
So what's interesting is now we're seeing this, flow over to silver and platinum, and they're alternatives to gold at this expense. And it's taken silver, 45 years to catch up to its all-time high. But also these other minerals and metals have industrial uses, so they're important to the AI infrastructure. And more importantly, the US government has now called silver a critical mineral, which means it's got strategic importance also into national security. So yes, it can sustain this even without kind of the central bank buying, because it has industrial uses, and it's now got a floor given its labeling as a critical mineral.
Meanwhile, copper prices are racing towards a record high, yet physical demand has been lackluster in recent months. How big a red flag is that?
What we saw, in April was that copper prices are quite sensitive to some of these tariff uncertainties. And so we expect that copper prices will again be a lot more volatile. And, as long as we have these macro risks still at play, people may be doing a wait and see rather than this is a red flag.
Copper mining is notoriously risky, though, and this year's disruptions are off the charts. Is this a warning to stay away from mining stocks?
I think, what we saw is mining stocks have learned lessons from their past. And so they have really strong balance sheets at this point. They have really strong cash flows. So I think they're still being quite conservative with the underlying metal pricing. So I think there's still a lot more room for these miners, and they're still playing catch up. And we're seeing this leverage play to the underlying metal prices. So I think, this again is going to be, there's volatility in these prices, but there's still a lot of upside backed up by fundamentals.
So finally, Joy, rare earths are now a pawn in the US-China trade war. As tensions rise and export controls tighten, how can investors play the critical minerals boom?
So I think what we're seeing is that critical minerals are like the new oil, and that, this is going to be very strategic for countries around the world, but it's important for investors to remain diversified in their allocations to each of these minerals and alternative assets. And it's important to be disciplined through some of these headlines. So I think the key point is, remain diversified and remain, disciplined.
That was Joy Yang from MarketVector Indexes. Don't forget, you can watch more videos on Reuters.com.